Number one is the cash and futures convergence. As we spoke about in the past, the price of the futures contract and the price of the cash contract eventually have to match up and be the same. They can't go along always being with a huge gap. There are opportunities for foreign currency traders to take advantage of that. If you have a futures account and you have a forex account, you're able to buy the cash and sell the futures, or vice versa, to take advantage of the narrowing of these two contracts. And it's profitable. That's how you're able to make money. Now, we saw how LTCM traded, and they looked for the risk-free arbitrage. So I can't guarantee that every time you attempt this type of trade, you won't have a problem. But irregardless, this is definitely an advantage of you trading both markets simultaneously. Another opportunity is the spread positioning between cash and futures. We spoke earlier about how the Mexican peso cost about $6,000 in initial margin to trade, whereas the forex market, you could just put up $1,000 and trade the peso. Well, there's something unique that goes on with futures trading. There are actually 3 different margins. In the last seminar, when I talked about futures trading, I only spoke about 2. I talked about the initial margin, which in this case would be the $6,000 that the Mexican peso needs. And then I talked about maintenance margins. So if the market moves against you, there's a minimum amount of margin that's required. So with the Mexican peso, it may be $4,200 or $4,100 for maintenance. But there's actually a 3rd margin that is reserved for hedgers only. This margin is known as the spread margin. This margin reflects the diminished volatility that you have by having a position in both the cash market and the futures market, or the diminished volatility of having a position in the futures market in 1 month and then having a position in a futures market further out. This spread position only for the forex market, for Mexican peso or euro currency or any number of the currency exchanges, tends to be in the range of about $400. Yes, $400 to trade the forex and the cash market simultaneously, because your volatility has been reduced. You don't have a naked position. This is great. So for $1,400, $1,000 in the OTC market and another $400 in the futures market, you are capable of having a protected investment. Either you're protecting the long-term belief that the cash market's going to go up, or the long-term belief that the cash market's going to go down, and you're able to roll over your OTC position while still protecting yourself from any downward exposure in the exchange-traded market. It's a great tool, and with the diminished price, why not take advantage of it? And all it takes on an opening account form in futures is to mark yourself off as a hedger as opposed to a speculator to take advantage of these type of prices. Third is the potential to use futures as a way to protect your long-term cash and spot positions. As we said before, you're forced to roll over your position if you don't deliver, and you have interest rate costs. Well, you can diminish those interest rate costs by having a futures position. Fourth, you can write options on futures against your cash position. This means that if you have a belief that the Swiss franc is going up, but you want to generate income while it's going up, you can actually write options in your futures account against your cash position. And as long as the value of the cash position matches up with the value of the options you have out there, you're pretty much covered, and you've created a covered call or a covered put position. And it's definitely an easy way to create income and still have the benefits of trading the cash market. Fifth, understanding normal markets versus backwardation markets. As I said before, I've covered this, but I can't emphasize it enough that when you understand how normal markets work, where you have further out months costing more than near-term months, and backwardation months, where you have near-term months costing more than further out months, you're able to see what is happening, how the Forex market is getting overheated, and how aggressive a stance you should take when investing in the OTC Forex market. So these two markets play against each other, so don't ignore the pricing structure of one for the other. Use them in complement. The Forex market, the Forex OTC market, is a direct extension of the futures Forex or currency market, and vice versa. They work together. Also, you can use the futures Forex market to take advantage of longer-term trending. You may look and see that the European currency is headed for a long-term move up, but the OTC market is having a short hiccup in the meantime. So you can look at that, see the futures market as an opportunity to take advantage of the long-term trend, buy into it, and not have to worry on a day-to-day basis about rollover interest or having to do swaps to grab forward contracts. Very simple way to have the two play off of one another. And then lastly, focus your trading mainly in the Chicago Mercantile Exchange. As I spoke before, the Chicago Mercantile Exchange has been around since the inception of the currency exchange markets. They are designed to protect those companies, those banks and dealers in the cash market from overexposure in the cash market, and so most of those banks and dealers work in the Chicago Mercantile Exchange. So when you trade the Chicago Mercantile Exchange, you're actually getting a great glimpse into the minds of those banks and dealers that are in the cash market. So focus your trading there, as well as focus your research and understanding of the Commitment of Traders report and using the various technical analysis indicators that we talked about before.